All right. My name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible while keeping them out of jail. So today I wanted to talk about the pass-through entity tax selection. So when Trump came into office and had that sweeping tax law changes, we'll call it the Trump tax law changes, one of the big changes that affected folks, especially in the blue states where taxes tend to be higher. There'll be income tax, property tax, whatever have you. They limited the amount of those taxes that you can deduct on your federal return. So prior to this change, any property taxes, any income taxes that you had to pay, you were able to deduct 100% of that on your federal return. So for many of those that lived in high tax areas, that was always the offsetting benefit of paying the higher taxes, where folks maybe didn't mind as much because you're like, well, at least I'm getting a benefit of it on my federal taxes. I'm paying a ton in property taxes. I pay a lot of state income taxes, but I get that deduction on my federal. So it works out. That was one of the big changes with that. So what the states started doing in response, and this is really only for business owners, specifically those that are owners of S corporations, partnerships, or multi-member LLCs, what the state started doing to benefit the business owners in those situations were they created this pass-through entity tax, where essentially what it allows those business owners to do is allow the business, your S corp or your partnership, to pay the partner or shareholder's share of their state income tax on their behalf. Now that's key. And that was big because now that the entity or the company is paying the partner or owner's share of the state income tax, kind of knocked out two birds with one stone. So it allows you to pay the state income taxes that you would owe, but it also allows you to still get that deduction for it on your federal taxes. So it was a great workaround. A lot of states started to implement it. You started seeing it in like 2019, 2020, and now many of the states that have income tax have now adopted this. It was a workaround around the Trump tax law changes. So again, it really only benefits business owners. If you're not in that situation, can't really get much benefit of it. And there hasn't been a workaround yet created, but they were able to do it for business owners. So quite interesting. Now, I wanted to get into the history and explain that because it can be a real tax saver, at least on the federal side, for those in that situation. It can save you a lot of money in taxes, at least with the IRS, if implemented properly. What I wanted to talk about is implemented properly, because with many of the states, now every state has their own requirements as far as how to activate and how to claim credit. What some clients of mine have run into is that they haven't implemented this properly, and then as a result, they don't get to take the deduction. And as a result, they wind up owing more in federal taxes than what they should be paying. And depending upon the amount of income that you had, if you're a relatively higher income earner, it could add up to thousands of dollars in additional tax that you unnecessarily have to pay. So the key here is to make sure that you do the implementation properly. So many of the states, in order to exercise this, you have to claim to elect it. And where many folks get jammed up is that you have to elect to take advantage of this well before tax time. So where I've seen folks get jammed up is that they decide that they want to take advantage of this, but they want to do it at tax time. And depending upon the state, because every state has different rules and regulations, but depending upon the state, if you wait until tax time to take the election, it's too late and you can't do it. So for example, New York and New Jersey, where I have a lot of my clients, you have to make that election to do it in March of that year that you're doing it. So right now I'm filming this in March of 24, and I just finished doing this with a lot of my clients. So for those that want to take advantage of it for 2024, you have to make the election by March 15th of 2024. Keep in mind, you normally don't do your taxes for 24 until 25, 2025. So you can't wait till 2025, if your company is based out of New York and New Jersey. If your partnership or corporation S corp is based out of New York and New Jersey, you can't wait until you do your taxes for 24 and 2025 to make the election. You have to do it earlier on in March. California, they have a June, I think it's June 15th cutoff date. So their date is in June. And again, the problem is that some folks have waited until it's time to do the taxes for that year. At that point, you're 6 to 9 months late in making that election. So the warning here is to make sure that you know your state's laws, because every state is different with the election, because there are some states where you don't need to make the election at all, and they're very lenient with it. So, and you can wait until it's time to file the taxes and do it. Some states want you to make an estimated payment in order to claim the election. So every state is different. What you need to do is, wherever you're active, make sure that you look up your state's laws and make that election on time, because if you don't, it can wind up costing quite a bit. So that's the tidbit of advice for today. I hope this was helpful. If you have any more questions about this particular topic or any other tax or accounting related questions, feel free to reach out. I'm happy to help. All right. That's all for now, and I'll talk to you in the next one.